Silver and gold saw an appreciable unwinding of net longs, while copper price movement have been more linked to supply disruptions. The news of Mr. Kevin Walsh being announced by the US President as the next Fed chair nominee followed quickly by an increase in margin requirements by derivative exchanges and an already leveraged buildup in the precious metal space were the three key reasons behind the price drop seen particularly in silver and gold during late last month, January of 2026. Market ruminations over Mr. Walsh's hawkish views on monetary policy and his strong views around Fed independence led to sharp dollar strength. And this caused yet another round of price impact on metals. Remember here that precious metals do not generate yields. And when markets read Mr. Walsh's nomination as relatively negative, there was a rush seen into the US dollar and also partly into US yields, as they at least give a certain amount of interest in the form of coupons. Further, speculative positions of traders reflected by the CFTC's combined non-commercial positions showed the build-up of net long positions being unwound in January of 2026. One must remember here that in highly leveraged markets, once the price downtrend starts, at certain threshold levels, price tends to turn self-fulfilling. In other words, the pace of drop in price feeds on itself. What then starts as a correction soon turns into something that resembles a crash as margin calls are activated and algorithm trades get triggered. It would be safe to say that what happened in late January partly resembled this. Now let's also look at copper that witnessed a sharp rally, in addition to silver and gold, though not as much or as sharp. Copper's rally, however, did not get dented as much in the metals correction witnessed late last month. This was mainly because the rally had been driven mostly by sharp production disruptions in certain mines around the world. In other words, significant supply bottlenecks. Copper mines in Indonesia, in Mexico, in Congo and Chile witnessed sharp production disruptions due to mudslides, earthquakes, accidents and strikes. In total, this is estimated to have impacted 5% of total copper mine production. This disruption is expected to remain as elevated all through till 2030.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.